Question 1. Understanding policy exclusions in term life insurance. Which of the following would most likely be considered a valid exclusion in a term life insurance policy? A. Death due to natural causes after the policy's expiration date. B. Death resulting from an accident occurring during the policy term. C. Death by suicide within the first 2 years of the policy. D. Death resulting from a terminal illness diagnosis after the policy was issued. Answer C. Death by suicide within the first 2 years of the policy. Explanation. Most term life insurance policies include a suicide clause, which states that if the insured commits suicide within a specified period, typically the first 2 years, the insurer may deny the claim. This exclusion is based on the premise of risk assessment and underwriting principles, aiming to prevent adverse selection where individuals may seek coverage primarily when they foresee imminent death. Options and D describe situations where the death would likely be covered if the policy is in force. Option B is covered as accidental death during the policy term typically falls within the scope of coverage. Question 2. Scenario-based needs analysis. Mr. Thompson is a 35-year-old father of 2 who is considering purchasing a term life insurance policy. He currently earns $75,000 annually and has a mortgage of $200,000. After evaluating his family's current lifestyle and future needs, he estimates they would need at least 10 years of his income to maintain their standard of living in case of his untimely death. What is the minimum coverage amount he should consider for his term life insurance policy, excluding debt obligations? A. $750,000. B. $1 million. C. $1,200,000. D. $1,500,000. Answer B. $1 million. Explanation. To calculate the minimum coverage needed, Mr. Thompson should consider his annual income multiplied by the number of years of coverage desired. If he estimates that his family needs 10 years of his income, the calculation is minimum cover equals annual income x number over equals 75,000 x equals 150,000. However, if we consider that he also needs to cover the mortgage debt to avoid financial burden on his family, the total coverage requirement becomes total cover equals minimum coverage plus mortgage equals 750,000 plus 200 equals 150,000. Given the options and rounding typically done in insurance, the best estimate here is $1 million, which provides a cushion above the minimum calculated need and reflects common practices in financial planning for families. Question 3. Licensing requirements. What is a primary requirement for an individual to become a licensed life insurance producer in Idaho? Completing a minimum of 20 hours of continuing education every year. B. Passing a state-administered examination on life insurance principles. C. Holding a bachelor's degree in finance or a related field. D. Having a minimum of 3 years of prior experience in sales. Answer B. Passing a state-administered examination on life insurance principles. Explanation. In Idaho, individuals must pass a state-administered examination specific to life insurance principles to obtain a producer license. This requirement ensures that potential agents understand the complexities of life insurance products, regulations, and ethical considerations. Options A, C, and D do not accurately reflect Idaho's licensing requirements. While continuing education is necessary for license renewal, it is not a prerequisite for initial licensure. A degree is not mandated, nor is there a specific prior sales experience required to enter the field. Question 4. Understanding the time value of money in life insurance. Which of the following statements best describes the time value of money as it relates to life insurance? A. The present value of a future death benefit is less than its face value due to the discounting process. B. The time value of money indicates that the amount of premiums paid increases over time without any changes to the policy. C. The time value of money ensures that life insurance benefits are paid out in real time without delays. D. The future value of a premium payment is always equal to the sum of its present value and any interest earned. Answer A. The present value of a future death benefit is less than its face value due to the discounting process. Explanation. The time value of money concept asserts that money available today is worth more than the same amount in the future due to its potential earning capacity. In life insurance, this means that the present value of a death benefit is calculated by discounting it back to today's value. This is crucial for insurers to assess the risk and pricing of policies. Option B misrepresents the nature of premiums as they do not inherently increase over time without changes. Option C is misleading as payouts depend on policy conditions. Option D is incorrect because while premiums may accumulate interest, their future value is affected by the interest rate and the time period involved, not a simple sum of present values. Question 5. Benefits of term life insurance. Which of the following is considered a significant benefit of purchasing a term life insurance policy? A. Guaranteed cash value accumulation. B. Lower initial premiums compared to permanent policies. C. Coverage that lasts for the insured's entire lifetime. D. Availability of investment options within the policy. Answer B. Lower initial premiums compared to permanent policies. Explanation. Term life insurance is generally more affordable in terms of initial premiums when compared to whole life or universal life insurance, making it an attractive option for individuals seeking temporary coverage at a low cost. Option A is incorrect as term life does not accumulate cash value that is a feature of permanent insurance. Option C is misleading because term policies provide coverage for a specified term, not for life. Option D is incorrect as term policies do not typically offer investment options, they purely provide a death benefit. Question 6. Policy riders and endorsements. Which of the following riders would provide additional benefits to a policyholder in case of a terminal illness diagnosis? A. Accidental death benefit rider. B. Waiver of premium rider. C. Accelerated death benefit rider. D. Child term rider. Answer C. Accelerated death benefit rider. Explanation. An accelerated death benefit rider allows policyholders to receive a portion of their death benefit if diagnosed with a terminal illness, thereby providing financial support during critical times. This rider is essential for addressing immediate healthcare costs and planning. Option A provides benefits only in case of accidental death, while Option B waives premium payments during a disability but does not offer additional cash benefits for terminal illness. Option D relates to coverage for dependent children and does not pertain to terminal illness scenarios. Question 7. Claim process and documentation. When filing a claim for a term life insurance policy, which of the following documents is typically NOT required? A certified copy of the death certificate. B. The original insurance policy document. C. Medical records from the deceased physician. D. A completed claim form provided by the insurer. Answer C. Medical records from the deceased physician. Explanation. While insurers may require various documents to process a claim, medical records from the deceased physician are usually not required unless there are questions about the cause of death or the legitimacy of the claim. The essential documents typically include the death certificate, the original policy or its details, and a completed claim form. Option A is crucial for verifying the death, and Option B confirms the existence of the policy. Option D is necessary for the insurer to have the information needed to process the claim. Question 8. Ethical dilemmas in insurance sales. If an insurance agent knows that a potential client has a pre-existing medical condition that may affect their eligibility for term life insurance, what should the agent do? A. Advise the client to withhold this information to secure lower premiums. B. Inform the client about the need to disclose the condition during the application process. C. Reject the client's application outright based on the condition. D. Suggest the client apply for a policy with higher coverage to offset the risk. Answer B. Inform the client about the need to disclose the condition during the application process. Explanation. Ethical practice in insurance sales requires that agents act in the best interest of their clients, which includes being transparent about the need to disclose pre-existing medical conditions. This disclosure is vital for proper underwriting and ensures that claims will not be denied due to misrepresentation. Option is unethical and could lead to legal repercussions for both the agent and the client. Option C is inappropriate as the agent cannot make that decision without the underwriting process. Option D is also unethical as it does not address the potential implications of the medical condition honestly. Question 9. Underwriting principles. In the underwriting process for term life insurance, which factor is considered least relevant in assessing an applicant's risk? A. The applicant's age. B. The applicant's credit score. C. The applicant's health history. D. The applicant's occupation. Answer B. The applicant's credit score. Explanation. While age, health history, and occupation are critical factors in assessing an applicant's risk profile, a credit score is generally less relevant in the underwriting process for life insurance. Underwriters focus primarily on mortality risk associated with health and lifestyle factors. Although a credit score may influence some insurers regarding the financial responsibility of applicants, it does not directly correlate to the likelihood of death or the need for coverage. Options A, C, and D will provide significant insights into risk assessments based on statistical data related to mortality. Question 10. Evaluating insurance policies. When comparing two term life insurance policies, which of the following factors should not be a primary consideration? A, the length of the policy term. B, the type of death benefit level versus decreasing. C, the reputation of the insurance company. D, the applicant's favorite color. Answer D, the applicant's favorite color. Explanation: the applicant's favorite color is not a relevant factor in evaluating life insurance policies and should not influence the decision-making process. When comparing policies, it is crucial to consider the length of the term, the type of death benefit level or decreasing, and the insurer's reputation for financial stability and claims handling. These factors directly impact the effectiveness of the coverage and the assurance that claims will be paid when necessary. Options A, B, and C are all significant considerations in selecting the most appropriate term life insurance policy. Question 11. Policy exclusions in term life insurance. Which of the following is typically considered a common exclusion in a term life insurance policy? A, death resulting from a natural disaster. B, death due to suicide within the first 2 years of the policy. C, death from an accident while traveling. D, death due to illness after the policy is active. Answer B, death due to suicide within the first 2 years of the policy. Explanation: most term life insurance policies contain a suicide exclusion clause which states that if the insured commits suicide within a specified period, commonly the first 2 years, the insurer will not pay the death benefit. This clause exists because insurers want to minimize moral hazard and risk associated with the insured intentionally causing their own death. Options and C are generally covered unless specific exclusions apply. Option D also typically falls under standard coverage unless limited by specific exclusions regarding pre-existing conditions. Question 12. Impact of age on premiums. How does an applicant's age most significantly affect their term life insurance premiums? A, younger applicants generally pay higher premiums because they are considered riskier. B, older applicants generally pay lower premiums because they are expected to have fewer dependents. C, premiums are often lower for older applicants due to their more stable lifestyle. D, younger applicants generally pay lower premiums due to a longer life expectancy. Answer D, younger applicants generally pay lower premiums due to a longer life expectancy. Explanation: in life insurance underwriting, age is a critical factor because younger applicants are statistically expected to live longer, which reduces the insurer's risk. As a result, they usually receive lower premiums compared to older applicants who face higher mortality risk. Option A is incorrect as younger individuals are typically less risky. Option B misrepresents the situation since older applicants usually have higher premiums due to increased health risks. Option C is also incorrect as older individuals tend to have a higher likelihood of health issues leading to increased premiums. Question 13. Insurance terminology. Which of the following best describes the term underwriting in the context of life insurance? A, the process of paying out benefits upon the death of the insured. B, the evaluation of risk and determining the premium rates for applicants. C, the marketing strategies employed to sell insurance policies. D, the management of funds accumulated from policyholders. Answer B, the evaluation of risk and determining the premium rates for applicants. Explanation: underwriting refers to the process by which insurers assess the risk of insuring a person and decide how much premium to charge. This process includes reviewing an applicant's medical history, lifestyle choices, and other relevant factors to determine the insurability and appropriate pricing of the policy. Option A describes the claims process, while option C pertains to sales strategies, and option D refers to financial management, neither of which accurately represents underwriting. Question 14. Policy conversions. Which scenario allows a policyholder to convert their term life insurance policy into a permanent policy without providing evidence of insurability? A, the policyholder's health deteriorates significantly. B, the conversion privilege is included in the original policy. C, the term policy is nearing its expiration date. D, the policyholder reaches retirement age. Answer B, the conversion privilege is included in the original policy. Explanation: Many term life insurance policies come with a conversion option that allows policyholders to convert their term policy to a permanent policy without having to provide evidence of insurability, regardless of health changes. This feature is crucial for policyholders who may have developed health issues and want to maintain life insurance coverage. Option is incorrect. Deterioration in health typically requires evidence of insurability unless the conversion privilege is specified. Option C is misleading. The conversion option may exist irrespective of the expiration date. Option D is not relevant to conversion unless specified in the policy terms. Question 15. Claim denial reasons. Which of the following could lead to a claim denial in a term life insurance policy? A. The insured failed to disclose a previous diagnosis of cancer when applying for the policy. B. The insured died from natural causes after the policy had been in force for 3 years. C. The beneficiary named in the policy is the insured spouse. D. The policyholder paid the premiums on time throughout the term. Answer A. The insured failed to disclose a previous diagnosis of cancer when applying for the policy. Explanation. Non-disclosure of relevant medical history, such as a previous diagnosis of cancer, can lead to a claim denial due to misrepresentation or fraud. Insurers rely on the information provided during underwriting to assess risk accurately. If it is later found that the applicant omitted significant health information, the insurer may refuse to pay out the death benefit. Options B, C, and D are not valid grounds for denial if all requirements have been met. Question 16. Risk pooling concept. How does the concept of risk pooling benefit life insurance companies? A. It allows companies to charge higher premiums to high-risk individuals. B. It enables the company to increase its cash reserves without increasing premiums. C. It allows insurers to average out losses among a larger group of policyholders. D. It reduces the need for underwriting processes. Answer. C. It allows insurers to average out losses among a larger group of policyholders. Explanation. Risk pooling is the principle that spreads the financial risk of loss across a large number of insured individuals, allowing the insurer to predict overall claims more accurately and set premiums accordingly. By pooling the risks of many policyholders, insurers can balance out the costs of claims and maintain profitability. Option A is incorrect. Insurers may charge higher premiums based on risk factors but do not solely benefit from high-risk individuals. Option B is misleading as cash reserves are not directly increased through pooling. Option D is false because underwriting is essential to assess the risks involved. Question 17. Needs analysis in life insurance. In conducting a needs analysis for life insurance, which factor is least likely to be considered? A. The applicant's current income and expenses. B. The applicant's marital status and dependents. C. The applicant's favorite leisure activities. D. The applicant's debts and financial obligations. Answer. C. The applicant's favorite leisure activities. Explanation. A needs analysis for life insurance aims to determine the coverage amount required to protect the applicant's dependents financially. Factors such as current income, marital status, dependents, and existing debts are critical in assessing how much life insurance is necessary. The applicant's leisure activities have no bearing on their insurance needs and should not influence the analysis. Question 18. Regulatory changes. How can regulatory changes at the state level impact term life insurance policies? A. They can increase the cash value of all term policies automatically. B. They can alter the required disclosures insurers must provide to policyholders. C. They can decrease the number of policies available in the market. D. They can remove all exclusions from standard life insurance policies. Answer. B. They can alter the required disclosures insurers must provide to policyholders. Explanation. Regulatory changes can affect how insurers operate, including the specific disclosures they must provide to policyholders, such as the terms of coverage, exclusions, and premium calculations. This is essential for consumer protection and transparency. Option is incorrect as term policies do not have cash value. Option C may occur but is not guaranteed, and market dynamics play a larger role. Option D is false as exclusions in policies are often defined by state laws and cannot simply be removed without legislative changes. Question 19. Policy riders. Which of the following riders would allow a policyholder to add coverage for their children without needing to undergo medical underwriting? A. Waiver of premium rider. B. Child term rider. C. Accidental death benefit rider. D. Living benefits rider. Answer. B. Child term rider. Explanation. A child term rider allows the policyholder to add life insurance coverage for their dependent children, typically without requiring them to undergo individual underwriting. This rider provides a death benefit in the event of a child's death during the term of the policy. The waiver of premium rider applies to the policyholder, while accidental death and living benefits riders pertain to specific situations and do not directly relate to children's coverage. Question 20. Ethical selling practices. In the context of ethical selling practices in life insurance, which statement reflects best practices for agents? A. Agents should prioritize their commissions over the client's needs when making recommendations. B. Agents must ensure that all information provided to clients is accurate and not misleading. C. Agents can use aggressive sales tactics to close sales quickly as long as they comply with regulations. D. Agents should avoid discussing policy features that may not benefit the client. Answer: B. Agents must ensure that all information provided to clients is accurate and not misleading. Explanation: Ethical selling practices require that insurance agents provide accurate and clear information to clients, helping them understand their options and make informed decisions. Agents who prioritize their commissions or use aggressive tactics are not acting in the client's best interests. Option C is misleading. The compliance with regulations does not justify unethical behavior. Option D is also incorrect. Agents should thoroughly discuss all policy features to ensure clients make well-informed choices. Question 21. Policy types. Which of the following best describes a characteristic of a term life insurance policy? A. It builds cash value over time. B. It provides coverage for a specified period. C. It is renewable only at the insured's discretion. D. It is always more expensive than permanent life insurance. Answer: B. It provides coverage for a specified period. Explanation: Term life insurance offers coverage for a specific period, e.g., 10, 20, or 30 years, and does not accumulate cash value. If the insured dies during this term, the policy pays the death benefit. Options A and D are incorrect. Term policies do not build cash value and are generally less expensive than permanent policies. Option C is misleading, as many term policies can be renewed, but the renewal is often subject to the insurer's terms and conditions. Question 22. Beneficiary designations. In life insurance, what is the primary purpose of naming a beneficiary? A. To determine the premium amount for the policy. B. To specify who will receive the death benefit upon the insured's death. C. To establish the cash value of the policy. D. To limit the coverage amount provided by the policy. Answer: B. To specify who will receive the death benefit upon the insured's death. Explanation: The primary purpose of naming a beneficiary is to designate who will receive the death benefit when the insured passes away. This ensures that the funds go directly to the intended recipient. S. Option is incorrect, as premium amounts are determined by other factors. Option C misrepresents the purpose of a beneficiary, as cash value pertains to permanent policies. Option D is also incorrect, because naming a beneficiary does not limit the coverage amount. Question 23. Conversion options. What is a typical feature of term life insurance regarding conversion to permanent insurance? A. The insured must reapply for a new policy. B. The conversion must happen within a specific time frame. C. The premiums for the new policy will always be lower than the term policy. D. The insured can convert at any time without any conditions. Answer: B. The conversion must happen within a specific time frame. Explanation: Many term life insurance policies include a conversion option that allows policyholders to convert their term policy to a permanent one within a specified time frame, usually before the term expires. This feature provides flexibility but often comes with specific conditions. Option is incorrect, as policyholders usually do not need to reapply but can convert directly. Option C is misleading, as the premiums for the new policy may be higher due to increased age. Option D is false. A conversion typically requires adherence to set conditions. Question 24. Factors affecting premium rates. Which of the following factors most directly influences the premium rates of a term life insurance policy? A. The insured's hobbies and interests. B. The age and health status of the insured at the time of application. C. The amount of the death benefit. D. The beneficiary's relationship to the insured. Answer: B. The age and health status of the insured at the time of application. Explanation: The age and health of the insured are critical factors in determining life insurance premiums. Younger, healthier individuals typically receive lower rates because they represent a lower risk to insurers. While options A and C are also important, the primary influences are age and health. Option D does not affect premium rates, rather it relates to the payout structure of the policy. Question 25. Riders and additional benefits. What is the purpose of an accelerated death benefit rider in a life insurance policy? A. To provide additional coverage for dependents. B. To allow the policyholder to access the portion of the death benefit if diagnosed with a terminal illness. C. To waive premiums in case of disability. D. To increase the cash value of the policy. Answer: B. To allow the policyholder to access a portion of the death benefit if diagnosed with a terminal illness. Explanation: An accelerated death benefit rider enables the policyholder to receive a portion of the death benefit while still alive if they are diagnosed with a terminal illness. This can help cover medical expenses and other costs associated with end-of-life care. Options A, C, and D describe other types of riders but do not accurately represent the function of the accelerated death benefit rider. Question 26. Insurable interest. What is the concept of insurable interest in life insurance? A. The insurer's obligation to pay out the death benefit. B. The requirement that the insured must have a financial stake in the life of the insured. C. The maximum limit of coverage available. D. The right of the insurer to cancel the policy. Answer: B. The requirement that the insured must have a financial stake in the life of the insured. Explanation: Insurable interest is a legal requirement that mandates the policyholder must have a legitimate interest in the life of the insured, typically based on relationships like family or financial dependence. This principle prevents people from taking out insurance on lives where they have no meaningful connection. Options A and D do not accurately describe insurable interest, while option C is irrelevant. Question 27. Claims process. Which step is typically first in the claims process for a term life insurance policy? A. The beneficiary submits a claim form to the insurance company. B. The insurer assesses the validity of the claim. C. The insurer pays out the death benefit. D. The policyholder contacts the insurance agent. Answer A. The beneficiary submits a claim form to the insurance company. Explanation: The claims process begins when the beneficiary submits a claim form along with a copy of the death certificate and any other required documentation to the insurance company. Following this, the insurer will assess the claim's validity before proceeding to payout. Options B, C, and D are subsequent steps in the claims process. Question 28. Life insurance market trends. What recent trend in the life insurance market has significantly affected term life insurance sales? A. Decrease in consumer awareness of insurance products. B. Increase in demand for simplified underwriting processes. C. Decline in the number of insurers offering term life policies. D. Increase in premium rates across all types of life insurance. Answer: B. Increase in demand for simplified underwriting processes. Explanation: The trend towards simplified underwriting has made it easier for consumers to obtain term life insurance without extensive medical examinations, thereby boosting sales. This shift responds to consumer demand for faster and more convenient insurance solutions. Options A and C do not reflect current market trends, while D is misleading, as not all policies see an increase in rates uniformly. Question 29. Tax implications. What is the tax implication for beneficiaries of a term life insurance policy upon the insured's death? A. The death benefit is subject to income tax for the beneficiary. B. The death benefit is typically received tax-free by the beneficiary. C. The death benefit is added to the estate and taxed accordingly. D. The death benefit is considered a gift and taxed as such. Answer: B. The death benefit is typically received tax-free by the beneficiary. Explanation: Generally, the death benefit paid to beneficiaries from a life insurance policy is not subject to federal income tax, allowing them to receive the full amount as intended. However, if the death benefit is paid to the estate, it may be subject to estate taxes. Options A, C, and D misrepresent the tax implications related to life insurance benefits. Question 30. Policy lapse. What typically happens when a term life insurance policy lapses due to non-payment of premiums? A. The insured continues to be covered until the next premium is due. B. The policy automatically converts to a whole life policy. C. The coverage ends and the insured has no further benefits. D. The insurer is required to refund the premiums paid. Answer: C. The coverage ends and the insured has no further benefits. Explanation: when a term life insurance policy lapses due to non-payment, the coverage typically ends and the insured no longer has any benefits under the policy. Insurers do not automatically convert term policies to whole life nor refund premiums unless specified in a contractual agreement. Options A and B are incorrect, as non-payment leads to termination of coverage without conversion.